We've been staring down the barrel of a recession for months at this point, ever since inflation reared its ugly head and the Federal Reserve finally started to curb the free money in our economy. But many people have just been outright denying this reality, claiming that all is well, that the economy is actually strong, not weak, and that a second tech boom is on its way, sure to bring riches to everyone invested in Bitcoin and Tesla. The truth is, though, that the globe's most powerful and influential financial institutions know what is about to come, and they've started to reveal it all to us. Most recently, we've seen Morgan Stanley ringing the alarm bells, warning us all of what is about to come, a name that is so ingrained into our banking system itself that during the 2008 global financial crisis, the Federal Reserve asked them how to fix the issues in the market right before they were forced to borrow $107 billion from the Federal Reserve, the largest of any bank in history. Now, warning signs are starting to appear again, and they are telling us that we're on our way to the next great recession. What we do with this information is up to us, but it's imperative that we know what's happening as we speak. Now, there's an obvious place to start here with Morgan Stanley, as they're a global firm that have over 80,000 full-time employees. They have offices in every major city you can name around the world, and they control $1.1 trillion in assets under management, and they're worth over $160 billion. Now, as is so often the case with these types of institutions, they routinely put out packets of information for their most important customers and investors, which explains exactly what's happening in the world, what's happening with their business, and what they think is going to happen next. So recently, that's exactly what Morgan Stanley did. They put out their 2023 investment outlook, and the details are seriously worth paying attention to. Now, they make a few different main points. The first is that when 2022 is over, equity investors will think that didn't turn out nearly as bad as it felt. This is mostly understandable, as when 2022 actually kicked off, we were inundated with headlines stating that it was the worst start to a year for 50 years of markets, or it was the worst year to be invested in stocks since the global financial crisis. Now, both of these facts were true. Assets in general performed really badly throughout 2022, but we had some odd moments. We had bear traps or mini bull runs where stocks were rising for 7 or even 8 weeks at a time, and when December finally ended, the S&P 500 was only down by about 20%, more like 30% when taking into account inflation granted. But compared to the headlines, compared to the largest war in Europe since the Second World War breaking out, compared to gas prices tripling almost overnight and causing an energy crisis all over the world, compared to China locking down tens of millions of citizens when 20 COVID cases emerged, most people thought it was going to be worse than it ended up being. As a result, equity investors in early 2023 have been cautiously optimistic, with many thinking that the threat from inflation is over, that it's been successfully curbed by the Fed, that the markets have avoided a Black Monday-esque event, and that a recession will be skirted as well. Morgan Stanley actually predicted that this would happen in advance. They explicitly said that investors will think that didn't turn out nearly as bad as it felt at times, but they also think that these investors, that they're getting carried away expecting a miracle to occur where everything turns out perfectly fine, and that's just not going to happen. In particular, Morgan Stanley are looking at yield curves and their current inversion. For those who don't know, this refers to bond yields and how usually the longer term the bond, the higher the yield on that bond to account for extended inflation over time. But when a recession is on its way, bonds start to price in the likelihood of a slash in interest rates as central banks pull out all the stops to try and get the economy moving, and this leads to bond yields flipping around, so longer term bonds actually have lower yields than shorter term bonds. We are now currently seeing this all over the place literally right now. As of late January, the 10-year Treasury yield is sitting at 3.37%, while the yield on a 2-year Treasury was 4.06%. This means the markets are pricing in a recession, and this signal is never wrong, not since 1978. The only problem is that this is a brilliant indicator for telling us that a recession is coming, but it's not very good at telling us when a recession is coming. In 2006, there were 22 months between the inversion and the eventual recession, whereas in 1980, there were just 10 months. Morgan Stanley in their outlooks say that they are sure a recession is coming, but that it might be delayed a few extra months. The economy is proving too resilient, causing the looming collapse in earnings to remain elusive for yet another quarter. They're expecting company earnings to fall in 2023, yes, but not to yet collapse, as that will likely take another few months to materialize. What this will do, though, is make the crash worse when it finally comes. This is likely all related to consumer savings and the fact that most Americans stocked up on cash throughout the pandemic, and as inflation and layoffs have been eating into their wallets, they've just been maintaining their current high spending levels while eating into their savings. The savings rate of Americans today is lower than it was at the worst point of the global financial crisis. In fact, it's on its way down to the lowest we've seen it in almost 100 years since the Great Depression. At some point, and almost certainly in 2023, those savings will run dry and spending in the economy will halt in an instant, and that will give us our crash. Morgan Stanley in this document, though, also outlined a number of other fundamental problems that they're keeping an eye on. They're worried about antitrust action from the US government towards tech giants like Google and Apple, which we have seen accelerate over the last year, most recently with the Department of Justice coming after Google for having a monopoly on the internet's advertising market. Now, if Morgan Stanley are warning you about the coming recession, you might be thinking about diversifying your portfolio away from these assets that keep bleeding you dry, or maybe you just want to hedge against inflation. Gold is one of the only assets that hasn't been getting hammered over the last year, and it's making a comeback in many investors' portfolios as they seek to protect themselves from the bear market and inflation. Vaulted is the best way for investors to acquire physical gold, with a great website and mobile app that makes it easier than it's ever been. They store and insure their one-to-one allocated gold in the Royal Canadian Mint, and you can rest easy in the knowledge that you can request instant physical delivery of your gold holdings whenever or wherever you desire. Their prices are the best in the market because they store all their gold at the manufacturer and they cut out all unnecessary middlemen. They don't charge any premium or spread when buying or selling you gold, and they are as transparent as possible, meaning there are absolutely no hidden fees. I highly suggest you check Vaulted out. There's a link for you all down below in the comments and the description. Again, that's Vaulted with the link down below in the comments and the description. But now back to the video, and many people will be watching this video and thinking, actually, I expected Morgan Stanley to say worse stuff about the economy. I expected them to be seriously expecting Armageddon, and this is where it gets interesting because they're pushing two separate lines of attack at the exact same time. Mike Wilson is Morgan Stanley's chief US equity strategist and their overall chief investment officer, and he says that corporate profit estimates are still too high, and that's after they've already been dropped in recent months, and their equity risk premium is at its lowest since the run-up to the 2008 financial crisis. That means stocks have never been so risky and presented such a poor potential return in the last 15 years, and it was only worse right before we saw Lehman Brothers collapse, 100 other banks collapse, and the largest bailouts in all of human history. So needless to say, that's really not good news, and it's coming from the most senior analyst at Morgan Stanley. He also said that the consensus could be right directionally, but wrong in terms of magnitude, meaning that stocks do fall, but in a far quicker manner and far faster than the markets are expecting, with Mike outlining a 22% decline of the S&P 500 over the next few months as a distinct possibility. Maybe Mike Wilson is a bit of a trailblazer then, maybe he's just too out there and his predictions never end up coming true, you might be saying. Well, sadly, his track record is actually fantastic, with him being ranked the #1 investor in the world in last year's Institutional Investor Survey, because he got absolutely everything about 2022 correct. The only thing he's not sure about is when this chaos is going to start, when are investors finally going to realize that the recession is real, that companies will see their earnings fall, and that the markets are therefore overvalued. Well, Mike Wilson thinks it's this calendar quarter. He thinks it's going to happen in the first 3 months of 2023, and we're already onto the second month now. Now, Morgan Stanley have actually been way ahead of the pack throughout this bear market and in the run-up to it as well. A few months ago in October, they came out and said that the global economy is already in a global recession, and they're one of the few banks today being honest with their customers about their outlook for 2023. They've been saying since July last year that they're ready to slash costs when the recession actually comes. If things really deteriorated, particularly in the US, then we take a much more aggressive position, and we obviously have the ultimate weapon, which is comp or compensation or salaries and bonuses in layman's terms. Their investing banking revenues declined by 55% by mid-2022, so they've seen this recession coming in advance, and back in December, they took their first aggressive act as they fired 1,600 of their staff in a preemptive measure to ensure the company's solvency. Now that's only 2% of their staff, and it's a far cry away from the 10 to 20% layoffs that many tech companies have been making, but this is happening while the company is still technically thriving. They're just expecting things to drop off a cliff, so they're getting out in front of it all. The simple truth is that no one actually knows exactly what is going to happen on any specific time period, and we are constantly told not to try and time the markets and to just keep all our money invested even as stocks continue to fall. But predicting a recession has always been easier than these people would have you believe. You just have to open your eyes and listen to what the data is telling you. The difficult thing isn't knowing what is going to happen, it's knowing when it's going to happen. But that's only actually relevant if you're partaking in extremely risky strategies like shorting or leveraged options trading. If you're like me and you just want to buy into the markets at a better price point, then the risk is actually rather minimal, but the benefits can still be huge. I sold out of American markets in their entirety back in December of 2021, and so when I choose to buy back in, I'll be up by around 20% when everyone else is down by that much, and I'll have pushed my retirement earlier by 10 years. If you want to know how I did it back then and how I'll do it this time around too, then sign up to my free markets newsletter where I explain everything going on. Now, strangely enough though, while Morgan Stanley and many other banks have sent the alarm bells ringing for American and European markets, they're actually pushing bullish when it comes to China, which is eerily similar to what the Michael Burry from The Big Short has also been hinting at recently. And you can find out about that with this video here. Make sure to check out Stoic Markets, our free newsletter, in the description, and our sponsor for this video, Vaulted.